Good evening from Money Matters TV. I'm Paul Sloate, CEO of Green Drake Partners, and with me tonight as my co-host is Patricia Dunn, Senior VP, Wealth Management of Merrill Lynch. A little bit later on in the show, we will be talking with Chuck Steege, President of SFG Wealth Planning Services and SFG Investment Advisors. Good evening, Pat.
Good evening. Good to see you again.
Good to see you. Well, the economy appears to be picking up and moving in the right direction. What do you think's impacting it and influencing it at this point?
Actually, there's a lot going on right now. First of all, we have a low inflation, and that's helping both consumers and businesses. We're seeing a resurgence in manufacturing and exporting, and actually a resurgence in energy. And the combination of the resurgence in manufacturing and energy, we're finally starting to see an impact broadening out across the economy. And from the consumer, we're starting to see people shift from paying off debt to actually taking on more debt, and that actually acts as a stimulus. And the Eurozone seems to be settling down, getting a little bit stronger, and finally yields are continuing to decline. So all of this is adding up to the economy improving.
Well, that sounds good, Pat. So as you look at the landscape out there, what do you see for the investor, and where do you think the investor should be moving given that the economy is finally moving forward?
Actually, I see a lot of movement in the United States market, in the domestic equity market, particularly the mega caps and the large caps. Now, it's not going to be like the roaring 90s where we just take off. It's going to be steady as she goes. But I think you're going to see more in that arena. And if we go overseas, I would look at blue chip stocks in the Eurozone because that's starting to improve, rather than shifting towards emerging markets. I think Europe is going to catch up to where we are today. I think they are where we were in '09 when things started to turn around.
Well, that sounds really good, and thank you for that advice. So besides those two things, do you have any other parts of the market besides investing in Europe, which is what you appear to be saying, and looking at sort of blue chips, large caps, which have not played so far in the market or are just starting to begin to move in the market? Are there any other things investors should be looking at?
I would say getting out of bonds or reducing your exposure to bonds, because at some point interest rates will have to start climbing again. Now, not likely until about 2015. Janet Yellen's very dovish about how she wants to handle the rates, and she said it's going to be some time. But some time is getting to be not so far away. So I would start decreasing bond positions and start emphasizing good quality blue chip stocks that pay dividends.
Well, that sounds like sound advice.
Thank you. Now, I wanted to ask you a question. In this area of people stopping paying off their debt and taking on more debt, what can you tell us about capital investments?
Well, what's happened in the economy really to date is that businesses have not spent a lot of money on capital. In fact, if you look at the amount of money relative revenues or earnings or cash flow for companies, it's significantly below where it was in the 90s and the 80s, and has been that way since the early 2000s. And what started to happen is that there are two things. One, the ability of business to push off needed spending is becoming more and more difficult, and they're starting to have to raise capital investment just to replace the machinery, to build some extra capacity. I mean, a simple example is the airline industry has added basically no capacity over the last decade, even though the number of people flying has been rising 3 to 4% a year for a decade. Well, the industry's out of capacity. There's no more seats on the planes. As anyone who flies knows, there's no extra seats on the planes. So they have started to reinvest in the business and buy new planes. In this case, it's leasing, but it's putting in place new planes, which is something they have not done for many, many years. What we're starting to see is in the commercial construction cycle, we're starting to see people building new commercial buildings. And that's beginning to start to happen. And also, if we start looking at corporations, we're seeing the beginnings of a capital spending cycle. Retail companies, if you look at the retail industry, their capital spending's up 10% year over year in the first quarter, and that's the first time that's happened since before the recession. So what we're beginning to see is that corporations that have had their hand, shall we say, holding back that spending spigot are beginning to open it up just a little bit to see how that works. And then I suspect as that begins to get deployed and the economy continues to grow, they'll spend more.
Terrific. So we have the consumer and the businesses starting to spend more.
Right. And
both stimulating.
correct. And that's another reason why interest rates are ultimately going to go up.
You're right.
Okay. It's time to speak to our guest. Our guest tonight is Chuck Steege of SFG Wealth Planning Services and SFG Investment Advisors. Good evening, Chuck.
Good evening.
So how are you tonight?
Very well.
Okay, so you're a specialist in performance awards. What are performance awards for our viewers?
Well, first off, thank you for having me on your show again. It's a pleasure to meet you, Pat, and good to see you again, Paul. So performance awards are basically companies are moving the direction of issuing more performance awards. Companies have, in large part, historically tried to figure out how to best incentivize senior level folks to drive the company performance. And so where there has been a bit of pushback, if you will, on certain types of awards, performance awards have come of age. So what are they? The answer is that performance awards are really awards that are tied directly to certain performance metrics. And so a senior executive might not best or might not get a grant in a particular award unless certain metrics are met.
Well, why do you think specifically it's gaining traction in public companies?
Okay, great question. So a lot of shareholder groups are looking very closely at executive compensation. Those shareholder groups are being advised by proxy advisors who are very much tuned into, for instance, Say on Pay, where shareholders want to have more of a voice, and shareholders want to make sure that their interests are closely aligned with in terms of the decisions that are made by the most senior level people within corporations.
So with this alignment, and for those of us who get to read the proxy statements, I know there's an alphabet soup of performance awards. Maybe you could go over for our viewers some of the different types of awards, some of the differences between those awards, and what they really mean in terms of incentivizing performance.
Okay, so companies are really trying to grapple with how to best issue awards. Each company is unique. It will have its own unique set of objectives. So you have performance share units or performance stock units. As an example, you have performance shares. You might also have performance options. So those are just a few of the forms of performance-based compensation and performance awards.
Well, can you give us some specifics around the metrics that are involved with each of these different options?
So companies will tie metrics to, for instance, top-line revenue growth, or earnings per share, or return on capital, or return on equity. They might even tie performance into customer satisfaction, operational efficiencies. Probably the biggest metric that's used by companies are total shareholder return, where maybe a particular stock price target needs to be met, or the company needs to have a certain growth percentage in their stock relative to other companies before that metric is actually met and before the award is actually made.
So if we were to look, so maybe you could, for our viewers, give them a little taste of what's the difference between, let's say, a performance stock unit and a performance share, and how maybe that differs from options that are awarded to management.
Okay. So a performance share unit, which most companies are issuing performance share units these days, they're a little bit easier administratively to deal with. Basically, the shares are not actually issued until there's a point of vesting for a performance share unit. Whereas a performance stock or a performance share, the shares are issued by the company and they're held, but they don't actually vest until some future point when the performance target is met. Why is that important to understand that difference? Well, the answer is you can imagine that there are a lot of tax aspects for a company to deal with. Shares, once they vest, then become taxable to the executive, and they don't become deductible until they vest. So a company will choose either a performance share unit or a performance stock based on when they actually want to release the shares. So with regards to performance options, as many investors are aware, options by and large have come under a lot of scrutiny where it's thought that executives are simply being rewarded given the fact that the stock price has gone up. And is there actual performance that has been achieved? Or is it just simply an executive doing his or her time? And so performance options, unless a performance target is met, an option will either not vest or be granted until that performance metric is met.
So if it's they have to reach a certain level of performance in order to be granted the option.
Correct.
But then doesn't that option in turn have to vest?
It does. And so depending on the type of performance award, the performance award option or the performance option may not be granted until that performance metric is met, in which case it then oftentimes becomes a time-based award from that point forward, where the executive then just simply has to do more time before there's vesting, or the performance could be directly tied to the actual vest. So there are these nuances, and you can already begin to get the sense that there's a fair amount of complexity when it comes to designing these various performance awards.
Are there specific, say, tax reasons why you might structure things in a particular way, where you might achieve a performance level that would give you the right to receive something, but then you have a period of vesting over which you're going to get the actual award? And is that all related to the tax consequences for both the individual and the company?
Absolutely. So let's talk about performance stock units. Performance stock units will earn along the way dividend equivalents, unlike a performance share where there's an actual dividend that's earned. So what happens with that dividend equivalent during the vesting period? It could be that it is not subject to taxation until vesting actually occurs. So then at that point, it becomes a deduction for the company and included in an executive's W-2.
Okay, so that's the point at which the executive would need to deal with the tax consequences of the actual award, even though they might have earned the award 3 years earlier.
Correct.
Okay.
And there's a little nuance in the tax code, and it really depends on the company, how they've structured their particular stock incentive. And that is whether an executive can make a short-term deferral of taxation. If an executive knows that they're going to retire in the new tax year, they may actually elect to make a short-term deferral so that they can suspend or defer the actual ordinary income tax event into the new year. Even though the award has actually been earned, they would be able to make that deferral. They can't avoid Social Security taxes, but they can avoid or defer ordinary income taxes.
Now, what happens if let's take that a little further. What happens if the executive is planning a retirement in the middle of this vesting schedule or passes away suddenly? Do they lose what's not vested? Do they automatically get vested?
Again, that depends on how the stock incentive plan is designed and the particular award is designed. There is some scrutiny around whether an executive should be able to vest an award in retirement because they're no longer working for the company. So should the vesting be accelerated just as a result of the fact that they are now retiring? Most times, a survivor is not going to be penalized by virtue of somebody passing on. So oftentimes there's an acceleration of a vesting that occurs upon death. But with regards to retirement, and that's a great question, there is a lot of scrutiny. Should a retired executive be entitled to vesting of unvested options just by virtue of the fact that they've retired from the company? Should there be an acceleration of vesting?
Yeah, and I guess also if the company has a mandatory retirement age which forces the executive to retire when they might not otherwise retire, that might also play into the decision.
That's correct. Mm-hmm.
Okay.
Yeah.
Okay. So these are all different flavors. If you're looking as an executive at this, what is sort of an optimal mix? I mean, because there's so many different things out there, and there's so many different metrics. Are some of these better for executives to get or more desirable to have as part of your package, or is it all, the answer is it depends?
So it does depend, and that's why compensation committees are trying to figure out how to best incentivize. Should there be a single metric in order for a grant to vest or be granted, or should there be multiple factors that enter in? I mentioned earlier total shareholder return. Should the total shareholder return be an absolute number based on the company's internal metrics, or should it be an award that vests or is granted by virtue of the fact that the company's total shareholder return has improved relative to its peers? So there's absolute internal and then total relative shareholder return. And so you can imagine the complexity that these do have. But I will tell you that there is this major move, this direction. In one case, one major proxy advisor would rather that a company issue north of 70% in the form of performance awards versus what have traditionally been in place in terms of time-based awards. It could be stock appreciation rights or options, which traditionally have been in place for executives. So there is this move towards performance awards.
Well, clearly, by moving towards performance rewards, you're tying your top-level executives' compensation directly to the performance of the company that they're running.
Correct. Yeah. So I mean, this is certainly something that comp committees continue to deal with. When I sit in on compensation meetings and listen to advisors, they are trying to grapple with, is an award simply one that retains talent, or is it one that actually drives performance to the company, and thus the reason why there's so much focus on performance awards.
Well, it's interesting. We could have a whole discussion on performance awards and whether they really incentivize performance, because there's a whole field out there that discusses that sometimes performance awards can actually be perverse and cause performance to be delayed. So it becomes a very, very interesting topic. And then if you're going to measure things, which metrics are you going to measure? Is it going to be the share price? Is it going to be the return on cap? I mean, there are so many different things. This can be a very complicated discussion. So when an executive comes to you, how do you decide how to advise them?
Thank you. I appreciate that. So most executives, most of our clients are the best and the brightest. Their biggest challenge is they lack time. What we do is we help them to navigate towards financial peace of mind. And that peace of mind is delivered by helping to simplify much of what is put on the table for them. So usually a company's performance is improved the more an executive understands how they're being compensated. Because performance awards are still relatively new, there's still a little bit of skepticism and confusion. And studies have shown where there is greater confusion, a company's performance isn't going to be as strong. So what we do is we help executives make sense of it all. We had one very senior level executive of a Fortune 500 company who, when he came into the office, we asked, what can we do to be of help to you? He said, I need for you to decomplexify my life. I thought that was a great term because there are so many moving parts, tax implications, timing of divestitures. This particular person, being in a very senior level position, had to deal with compliance. And as an insider, you can imagine that there are some additional layers to deal with. So what we do is we help to put organization to their picture.
Wonderful.
So when you look at these senior executives, and you just gave one advice, are their problems fairly similar and the issues they're all facing fairly similar in that they have these very complex things going on that relate to their compensation and what's going on in the company, and then we have this whole layer of the SEC and SEC oversight, and is whether it's a company that's, let's say, Fortune 500 or even a private company, are those issues fairly similar?
Well, certainly a private company, they are going to have certain performance metrics that are going to be a little bit different. So unlike a public company where you can either look to the stock price, and there's a lot of transparency around the financial aspects, for private equity, most times it might be driven off of increasing the multiple of equity and setting up for an eventual listing. And we've seen that with some of our private equity CEOs.
So, but how do you measure that increase in the multiple on equity, because it's a private company, and to some extent we all know that the value of that private company is related to the value of its peers in the public market. So the executive could do a really good job, but if the valuation of the peers in the private market goes down, it doesn't mean the multiple is going to expand.
And that's very, very tricky for the accounting people when an IPO or an S1 is filed with the SEC. The SEC has rendered a lot of comments more recently on stock valuation. As a private equity, you're telling us the stock was X, but now that the company is going public, it's at a certain level that's higher. So there is a need for very strict accounting explanations around how does fair value, for instance, get calculated. And so there is a lot of scrutiny, and the SEC is looking very closely at this.
And how frequently should this company be getting company valuations? Is this an every other year thing? Is this an every 3-year thing? How often should they have audited company valuations done?
That's a very good question. And I'm not a tax advisor to companies. We work with executives individually. So I don't altogether know how to answer that question. But I would think that a company's accountant would watch this very closely. There is, I mentioned fair value. There is a lot of complexity to how fair value is calculated. It's a little bit easier for a public company,
Yes.
Because maybe the company's got historical volatility or it's paying a dividend. Its stock price is such, where a Black-Scholes model is a little bit easier to calculate. Whereas a private equity, it's going to be a little bit difficult. And that's why there are specialists who will look at, particularly with a private equity company, will hire companies to do valuations.
Yeah, my experience at least is they hire outside specialists in valuation, and they come in and value the company. And how often that's done is driven by a whole host of factors we do not have time to discuss tonight. But I just want to ask one more question on the private equity. Do they use some of the same, we talked about multiples of business
Yes.
value, and this will sort of have to kind of wrap it up. But do they also use similar metrics to sort of return on capital and other earnings growth that we would expect for a public company?
I would say that private equity is going to be a little bit different a metric. One particular private equity CEO has both time-based options, but also performance-based options. And those performance-based options will vest either on a 3x of the current equity or a 5x of the current equity.
Okay. All right. So so it gets much more complicated when it's private equity. But as you can see, Chuck is an expert in this and has been doing this for a long time and knows what he's doing. Our next week guest is going to be Russell Mollitz. He is an MD, PhD, and he is with Starship Health, and he's going to be talking to us about healthcare IT. And from all of us here on Money Matters TV, your money matters.